Ladies and gentlemen, good day and welcome to Havells India Limited Q2 FY23 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Aniruddha Joshi from ICICI Securities. Thank you, and over to you, sir.
Yeah, thanks, Aman. On behalf of ICICI Securities, we welcome you all to Q2 FY23 results conference call of Havells India. We have with us entire senior management of Havells, represented by Mr. Anil Rai Gupta, Chairman and Managing Director, Mr. Rajesh Kumar Gupta, Whole-Time Director Finance and Group CFO, Mr. Amit Kumar Gupta, Whole-Time Director, and Mr. Rajiv Goyal, Executive Director. Now I hand over the call to the management for their initial comments, and then we will open the floor for question and answer. Thanks, and over to you, sir.
Thank you, Aniruddha. Good morning to all of you, and wishing you all a very happy Diwali. Hope you have reviewed the results by now. The second quarter saw decent revenue growth considering the inflationary environment. It's encouraging that majority of the sales growth was led by volume. Margins in quarter 2 were impacted by full absorption of high-cost inventory against falling raw materials and sales prices. The impact was more pronounced in cables and Lloyd. While high-cost cable inventory is now exhausted, Lloyd absorption would continue through Q3. We believe that margins have hit the trough and are expected to improve hereon. Real estate and infra presents a good opportunity. Overall demand outlook remains positive. Aniruddha, we can now proceed to Q&A.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets for asking a question. Ladies and gentlemen, we will wait for a moment while the queue assembles. Our first question is on the line of Aditya Bhartia from Investec. Please go ahead.
Hi, good morning, sir. Wish you a very happy Diwali.
Thank you.
So my first question is on the inventory level that we are seeing at the end of Q2. Versus historical levels, it appears to be still fairly high. So if commodity costs were to continue declining a little, does it mean that the benefit of raw material cost would not be entirely visible in Q3 either?
Well, overall inventory levels are high because of the build-up of the festival season. So primarily most of the businesses, the production has happened in the second quarter. So these are not old inventories. Except in case of ACs in Lloyd, which could not be sold completely because of the lower season in the second quarter, which will be absorbed in the third quarter, and eventually this will all be fresh inventory going into the third and fourth quarter.
Understood, sir. And secondly, sir, how should we really be looking at Lloyd's profitability from here on? When you say that high cost inventory would get liquidated by fourth quarter and normalized margins should start coming back, what are the kind of margins that you consider to be normal? And do you see it more at the gross margin or contribution margin level or at the EBIT margin level after all the operating leverage?
I think overall Lloyd will a lot focused also on the growth of revenues. So if you would have seen that we've grown more than 50% in the first half, and this momentum will continue to be there. We do see a huge opportunity for revenue growth, market share gains in air conditioners, but also revenue growth because of the addition of new product categories, which are gaining strength in the marketplace. It will have its own journey. So there's a huge opportunity for revenue growth, and that focus will continue to be there going into the next financial year as well. So there will be an upward trend. As I said, the margins in the second quarter were lower because of very different reasons. But going into the third quarter, practically most of the normalized margins will come back. But fourth quarter, we should expect normal levels, which should be in the range of about, low double digits contribution margins. However, there will be continued eye on the fact how the competition continues to behave. And, our first focus will be, market share gains and revenue growth in Lloyd. But also at those levels, we do believe that we will be fairly positive with, on the profitability side also, with good advertising input.
Understood, sir. Thank you so much.
Thank you. Our next question is from the line of Sonali Salgaonkar from Jefferies India. Please go ahead.
So thank you for the opportunity. So my first question is again on Lloyd. You did mention that by Q4 you expect low double-digit contribution margins in Lloyd. But sir, could you throw some light on the market share gains that we have had in Lloyd on a year-on-year basis? So this Q2 versus the last, because we have seen that consistently over the past 3 quarters, you have had a very good revenue growth, but margins unfortunately are consistently falling.
Yeah, I think let's maybe not even look at the quarter-on-quarter kind of revenue share, market share gains, because it's also difficult in this industry to actually get the exact numbers. But overall, we have seen that we have been able to garner market-leading growth in the last few quarters. So which does give us the impression, and we also believe that we are amongst now the top 3 players in the AC category. And hopefully we would like to continue that position and continue to grow faster than the market.
Understood. So any price revisions that we have done, any material price revisions which we have done over the past 2 quarters, especially for Lloyd or any other category?
So Lloyd is undergoing also a transition during the third quarter, because energy efficient norms will change from 1st of January. So both in case of fans and AC, there will be a price hike coming in the third quarter and going into the fourth quarter. So, but that is actually, higher cost products being sold at higher prices in the market.
Understood. So, and my second question is, could you throw some light on the festive trends, initial festive trends that you are looking at, especially if you are seeing any thing, different in any of the categories?
I think when we started getting into the festival season, we saw some slowdown in the pickup, because I think the trade was actually a bit slow to pick up inventory. But in the last couple of weeks, we have seen some good pickup, which is happening, which is also meaning good secondary sales are happening, and which means good primary sales are also happening. So we've seen a good uptick in the last couple of weeks. It's still early days. Let's see how the third quarter pans out, but it's a positive outlook.
Sure. And lastly, capex guidance. That's it from my side.
I'm sorry?
Capex. So your capex guidance.
So our water heater plant capacity is now fully online, and we hope that the new air conditioning facility would start some production in the fourth quarter as well. So that is on there, and we are also setting up a new facility in Concall. So overall, I think in this financial and next year put together should be anywhere between 1,000 to 1,200 crores. But most of it, which will come in this financial year, and some of it will be carried on in the next year as well.
So how much of this 1,000 to 1,200 crores is already done in FY23?
I think 165 crores was shown in the numbers which we have sent.
Got it.
It will be 700-800. Around 700.
700. Got it. Thank you, sir.
Thank you. The next question is from the line of Charanjit Singh from DSP Mutual Fund. Please go ahead.
Yeah. Hello, sir. Thanks for the opportunity. Sir, I just want to check first thing on the ECD segment. There, our growth has been, muted, and margins have also taken a, significant hit. So if you can highlight, specifically from fans and the appliances segmental perspective, how has been the, market scenario, and what's the outlook going forward from growth as well as the margin perspective in the ECD segment?
I think specifically if you look at the ECD segment in fans, we did see some slowdown, primarily because of some restocking happening, because the trade also wants to clear out their old energy efficiency norm products. So there will be a little bit of slowdown in fans even in the third quarter, but going forward in the fourth quarter, we should definitely see market coming back. Third quarter is generally a high season for water heaters and appliances, which should take care of the growth for ECD in the third quarter as well. Second and third quarter is anywhere lower for fans.
And sir, from profitability perspective, because if I look at the EBIT margins, last 2 quarters have been severely impacted. This segment used to see somewhere around 17% kind of a EBIT margin in a couple of quarters we have seen. So here the recovery in the margin, how long it could take, sir?
So because of a complete consumer nature of these products, as the raw material prices went up high, all the prices were not passed on to the market. With the raw material prices now stabilizing, we will continue to see improvement in the contribution margins and the EBIT margins in this category. Now, if you're comparing it with the highest quarters, I think that also was a little bit of on the other side, there were, lower costs associated with that as well. But we will continue to invest in our deeper penetration in the market as well as advertising.
Okay, so just last question from my side on the ad spending. So like you had earlier also highlighted that some of the costs will start normalizing, and ad spending is one number which is normalizing. So from the full year perspective, what's the kind of ad spending as a percent of sales we should look at, and what it could be, on a sustainable basis going forward in FY24?
Yeah, so ad spends, we have actually continued to normalize ad spends except the COVID years. We started off last second half and this year with normalized ad spends, and we definitely believe that it will be anywhere between 2.5% to 3% of the non-cable sales. So that will continue to remain.
Okay, sir. So thanks for taking my questions. That's all from my side.
Thank you. Our next question is from the line of Siddharth Bera from Nomura. Please go ahead.
Yeah, sir. Thanks for the opportunity. Sir, my first question is on the price increase. You said we will be taking in third quarter in the AC and fans category.
Your voice is, not very clear.
Okay. Is it better now or still weaker?
Please use the handset, Siddharth.
Sure. Just a second. So I just wanted to check on the price hike side, which you indicated that you will take some in AC and fans in the third quarter. Possible to highlight what will be the quantum for that?
I could not follow your question, please.
So you had indicated that we'll be taking some price increase in the third quarter in the AC and fans because of the higher costs. So possible to quantify how much will it be, and will that be sufficient enough to achieve the double-digit margins along with the contribution margins along with the lower cost of sourcing?
We're still evaluating the entire impact of that, and that will be passed on. Actually, it kicks in the fourth quarter, but the raw materials and inventories will start coming in the third quarter. But yes, that will not impact the margins positively or negatively for both the businesses.
Okay. And the margin, if I look at contribution margins, which have also declined quarter on quarter in quarter two, is there any element of price cuts or discounts also, because commodity costs have been largely stable, but our contribution margins have dropped? So any other factor here to look at?
No, it's primarily the high cost inventories which need to be looked at.
Okay. And so lastly, on the wire and cable side, I think last quarter we had seen some bit of channel destocking, and this quarter we had reported a strong growth. So any impact of the in channel inventory build-up which is there, if you can highlight, and whether this growth is sustainable or we should look at a more normalized number?
No, this is a more sustainable growth because there were no any major price fluctuations in the current quarter.
Okay. Got it, sir. Okay. I'll come back in the queue.
Thank you. The next question is from the line of Atul Tiwari from Citi. Please go ahead.
Yes, sir. Thanks a lot for the opportunity, and congratulations on continuing market share gains in Lloyd. So the question is slightly more medium term. So obviously in AC industry there are other players, MNCs are also present, Chinese and Japanese, and
I'm sorry,
India.
Your voice is not
but
clear.
your voice is not clear. Request you to please use the handset as well.
Yeah. So sir, this question is on Lloyd. So in the AC industry, obviously the competitive intensity is high, and with several large players present. So if these players decide to respond, are you okay to continue to operate at negative margins in Lloyd, say for an extended period of time, to gain and increase market share?
Atul, your voice is still not clear. I may request you to use the handset for the next question.
Hello, sir. Is it audible now? Hello.
Yeah, better now.
Yeah. So sir, the question was on the lawyers. So because obviously the competitive intensity is quite high in AC industry, and obviously other players also want to maintain or increase their market share. So are you okay to operate at negative margins for say next few years in case other players also decide to respond?
No, but Aditya, you have also seen, Atul, you have also seen that the second quarter negative margins. We've enumerated the reasons for that. It's not the competitive intensity that we're talking about. So I don't understand the tenor of your question.
So, sir, basically, obviously, second quarter of margins were very low because of one of reasons. That I understand. But it was like fourth or fifth quarter when the Lloyds has operated at negative EBIT margin. So it was not like the first quarter it was happening. Hence the question that is the intent to kind of gain market share, despite negative margins over extended period of time.
Yeah, so the whole idea is to actually look at the market share gains and all long-term investment in the brand and distribution, investment, because of we needed to change the perception of the brand as well as we change the distribution channels. So yes, it's over a medium period of time that will be the first focus.
Okay, sir. Great. That gives a lot of clarity. Thank you. Thanks a lot.
Thank you. The next question is from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Sir, thank you for taking my question. Again, sir, more medium term. I mean, we saw this period of COVID where demand went down, and then we saw last 12 to 18 months where there's an element of pent up and a lot of things happening. Now, from here, if you were to look at the next couple of years of demand, any sense you have, given the capacity that we've built in, we've set up factories, what is a realistic sort of demand that I think as a country, some of your segments could deliver? Just some ballpark thoughts about how you are thinking about demand.
I think if in the last couple of years you've seen post-COVID, let's look at the industrial and project segment. Things have started actually post-COVID very nicely, and this continues to show good growth in the even till now. Because of the high level of focus in the government, now new capex coming up, because of the slowdown in capex in the COVID cycle. So things are happening there on that side. We all know that, post-COVID, suddenly the real estate demand started doing well. One of the only negative factors there could be the high interest rate, but still, even today, the real estate cycle continues to do well. So I think in the medium term, we're quite hopeful because all our products, whether it's consumer side or industrial side, focus on this. This will be definitely a good run for demand cycle in the coming times. Also, the fact that electrification has now reached all the villages, so you'll see more and more tier 3 towns and rural areas. Their aspirations to buy higher quality products also increasing in the coming time. So I think, going forward in the next 2 or 3 years, this should all result in a decent growth outlook.
I mean, a follow-up to that, I mean, given the fact that rural has not been doing that well, and urban, obviously, that pent-up part at some stage will start slowing down. I understand the real estate story. Still, you feel that growth should be decent for us. That's what I'm trying to get to.
That's right. You talked about medium term, but real estate, the rural demand will, had slowed down more because of the inflationary pressure. So we do believe once that is taken care of, things should come back to normal.
Sure, sir. Thank you.
Thank you. Our next question is from the line of Rahul Agarwal from InCred Capital. Please go ahead.
Good morning. Thanks for the opportunity. Just two questions, sir. Firstly, on the fan side, I understand that the channel is not really comfortable with the changes. I think the understanding is still limited more on the B2C side. But the phenomenon should be different between, fans priced between 1,800 to, let's say, 2,500, and then something above that. Could you elaborate a bit, like what is the exact concern there? Like you obviously mentioned that 3Q should, still be volatile, and fourth quarter would see a lot of channel restocking with all the new stuff, new ratings. But just if you could elaborate between segments, between fans, like what is exactly the concern there?
So what do you mean by the concern? So the cost of the product will rise when you make the products with the new BE norm, right? So that will have to be passed on to the market. So the channel would definitely destock because they can't sell the old products after the 1st of January. So they would destock, they would try to clear off their inventory and then start buying the new products. So this happens in all the segments of the fans business, not just the lower end of the market.
So my understanding was the production has to stop from 1st Jan, not the sales, right? They can still sell in Jan, Feb, the old inventory. Is that correct?
That's right. So we can't sell from there on, but channel definitely wants to take a view that they also want to clear their inventory, which is the right thing to do actually.
Okay, got it. So we should see like some pre-buying happening in third quarter, and then fourth quarter should have more of new product sales. Is that correct?
Sorry, I think we were crossing each other. Second and third quarter is not a high season for fans anyway. So generally there are high levels of inventory. You're building up the inventory for the coming season. You also want to not manufacture the entire inventory at high cost for the fourth quarter. So you also want to push the material in the market, but the channel is also slow in picking up the material. So it's a combination of many things. So we do see some sort of a slowness in pickup for fans in the third quarter as well.
Got it, sir. And lastly, on lighting, any specific reason for lighting EBIT margins coming off QOQ by 200 bips? I thought this segment was relatively doing better in the past 6 months.
First of all, we had an accident in the factory in the lighting business, and thankfully it was only half of the factory. We have another factory where the production switch had to happen over a period of time. So, because of two reasons. One, the switching had to happen, and secondly, some amount of outsourcing is also there. So we do see some sort of a pressure on the margins in the lighting business, but hopefully it should be coming back to normal very soon. The good thing is that we have not lost sales in lighting because of the accident.
Got it, sir. That answers my question. Thank you so much, and I wish you a very happy Diwali to the Havells team. Thanks.
Thank you.
Thank you. Our next question is from the line of Srinidhi from HSBC. Please go ahead.
Yeah, hi. Thank you for the opportunity. Two questions from mine. So switchgear business revenue growth appears a bit soft, particularly given that you're highlighting that the real estate cycle seems to be an upcycle. There seems to be good infrastructure investment. So just wondering what is really happening that the growth is slightly slower than what we can achieve.
I don't think there's nothing much to read there. Overall, quarter on quarter things can vary a little bit, but overall, if you look at the CAGR, this has probably been a good run for switchgear in the last 2 years.
Okay, sir. And the second question, sir, you're guiding for a low double-digit contribution margin in Lloyd. Just wondering, does that presume a material fall in commodity prices from the current level or significant product price hikes by the industry as well as Lloyd?
So I think this is quite a moving, thing right now because we are also going through a transition of the BE norm. So a lot will depend upon how things pan out in the fourth quarter. But yes, it does assume the present raw material prices.
Okay. Thank you for answering my questions and all the very best, sir.
Thank you. Our next question is from the line of Latika Chopra from JP Morgan. Please go ahead.
Yeah, hi. Thanks for the opportunity. I just wanted to understand your comments on demand, a little better. It seems, B2B demand is where you're more positive on. On B2C side, you mentioned, demand is little sluggish but stable. Just want to, understand this better in the terms of, are you commenting this more from a fading of pent-up demand, or are you seeing incremental impact of inflation affecting consumer spending? Any color on consumer behavior, particularly on the B2C side, that you're witnessing, even in terms of product mix? If you could, elaborate a little better on this. And if you could also share the volume and price differential, for the quarterly growth rates for the key segments.
Okay, I think to your first question, I see this more as a inflationary pressure on the demand rather than a slowing up of the pent-up demand which happened in the past. So as a consumer trend, I would actually say there's not a whole lot of difference which was expected, that the consumer would start downtrading or downgrading towards a lower quality and lower spec products. It's actually not happening. Havells is catering to different segments of the market through various brands. So we actually don't see a major shift happening in the various brands of sales. Mass premium or the premium category continues to do well. What was the third question? Sorry. Volume growth. So volume growth, overall we see that almost 80% is, from the volume growth rather than the value growth. So 14% overall we have done in this quarter. Almost 12% is coming out of volume growth.
Sure. And, in a scenario, if over the next 6 months, not getting into the medium-term growth potential, but just looking at, the next 6 to 12 months, if you find that, consumer spending is constrained, do you think that industry will be willing to pass on pricing benefits to the consumers to drive market shares or to drive growth? And in that, in any way, constrains the ability to deliver margins, which used to be in the 13-14% band in the past. Would you be willing to operate at lower operating margins considering, market shares and growth is prioritized here?
Yeah. So, first of all, we do not know what will happen and how the competition will behave. We definitely do, the way we balance the businesses, we do react to how the competition would behave. But also we have a very long-term strategy on where we want to position the brand. So in the past, if you've seen, in most of the businesses, other than very fluctuating kind of businesses, we have seen very high intensity in Lloyd or cables and wires. Generally, our margins have been quite stable. This was only in the last 1 year where the fluctuation was extremely unprecedented. So I don't see that, reducing prices or increasing prices really changes your market share a whole lot, in which you really have to spend a whole lot of investment, both on brand, distribution and all that. So I think we do expect stability in margin, but yet, if there is high intensity in the competition, one has to adjust a little bit. That does not really change the profile a whole lot.
Okay, thank you. And the last question is on Lloyd. Just wanted to understand what is the absolute level of brand spend you make on Lloyd today, and what's the split between air conditioners versus, the new segments that you're entering in. And even if the contribution margins move up, to double-digit levels, could there be a disproportionate increase in these spends, and hence EBITDA margin expansion might not happen at a similar pace?
So first part, almost 25% of the ad spend go towards Lloyd. We don't really differentiate within Lloyd because we treat it as a brand positioning rather than just product to product at this present moment. There will be spikes for non-AC products during the season time and AC products, but we don't really distinguish within the Lloyd category. Sorry, I missed your second part of the question.
So we're trying to understand, do we expect, a disproportionate increase in these spends as you, scale up these new categories and, you expand, and hence the operating margin expansion could be a lot more limited versus, what you're seeing at a contribution level?
I think for Lloyd, we are definitely, wanting a bit of a long-term play here, where we want to build a certain category. It's almost like, where Havells was about 10 years back. And we do see a huge opportunity where not only the market is very large, but also the growth is high. and the discretionary spend of the consumers are increasing towards these products. So there will be a continued investment in the next 2 or 3 years on the brand side. And if, to use your word, yes, there will be a disproportionate investment in the brand building.
All right. Thank you so much.
Thank you. Next question is from the line of Chinmay Gandre from Reliance Nippon Life Insurance. Please go ahead.
Yeah, thank you for taking my question. So my question is basically on fans. As you did clarify that channel is allowed to sell the current rating fans post January 23 also. So normally, historically in AC, when this kind of things happen, normally we have seen that the channel kind of stock the older rating because they are also cheaper and basically they are allowed to sell. So why that phenomena you don't expect to repeat in fans, wherein fans like the channel is kind of destocking versus say buying the older inventory?
So yes, channel will be allowed to sell, but you see, while AC has seen these mini changes very sort of regularly, for fans it has happened after a long time. I think that dealer behavior has to still to be seen, and so I think there's a reason we are cautious of how the reaction will be, and that's why we have mentioned both in Q3 and Q1. I think we need to see how the reaction would be from the channel. Largely, the channel is inclined towards having the new category of fans. Having said that, look, there could be some stocking at Q3. But what we are trying to say, please differentiate between fans and ACs. That differentiation will continue to remain.
Sure. I mean, this thing also happened in Genset, and then in Genset also, like we see pre-buying. But anyways, and secondly, my question is on so price hikes. So post the new rating, so what could be the quantum of price hikes we would be required to take? And I presume they would be quite different for different rating of fans, right?
That's right. That will be there. So I think that is still being sort of looked at because it will depend upon a lot of variables. So maybe in Q3 we can be in better position to discuss that.
But are they going to be quite material to kind of maybe have some impact on demand going into for Q4 and I mean, from there on, or the quantums are not that quite high?
Look, quantum, the percentage quantum will depend upon the base price of the fan. Clearly, at the lower price fan, the impact will be higher than the high price fan.
Okay, sure. Thank you.
Thank you.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir.
Yeah.
Hi, sir. Good morning. So firstly, you spoke about, growth being 80% driven by volumes. Can you give some color on segment-wise, breakup of volume and value growth?
Actually, largely it's consistent across. Like for example, we can say in Lloyd it will be almost 100% is volume growth. And you are aware that there has not been much price revisions during this quarter. So, and that's what we have articulated as an encouraging sign. There's a volume growth which is coming back. In last 3 years, volume growth has been lower because there is a lot of price hikes. Now only this quarter, and that's one of the reasons why margins could have also not been what it has been. Because you see there has been the commodity cost continues to be high, but pricing has not been revised because now they are falling off. So mostly the growth you see across is led by volume, not by price.
Okay. So also, can you speak about your market share trend in the fans segment? Because from what we understand, the competitive intensity, there has gone up quite materially. So any color on how our market share is shaping up on the fan side?
I think market share wise, it's, over the last, again, as I said, for the other business also, we have to look at it over a longer period of time. We believe that we have gained market share in fans. And not only necessarily from the big brands, but also, there were a state of new brands which came up in the last 5 or 7 years, which grew at a certain pace, at a very fast pace to a certain level. And then eventually we've seen them slowing down. I think, again, the big brands with the national brands have tended to do better over the last couple of years, especially post-COVID. So we do see some consolidation of market shares happening in the fan business.
Okay. And so lastly, just, like a few quarters back, at the peak of COVID and then commodity prices, we were also talking about the smaller players being at a relative disadvantage in terms of their ability to manage cost and supply chain. So are they now completely back, you think, in terms of the business side, or so how is that part of the supply shaping up in your view?
Yeah, I would say they are, pretty much we are back to pre-COVID levels.
And we're not seeing that disrupting our market share on an incremental basis, right?
No, it depends upon business to business. As I said, in fans, we are actually seeing the other way around, that we are seeing some consolidation, even for the larger players. But, overall industry-wise, if we see certain disruption which happened for many players, it's now back to normal.
Sir, if I may just squeeze in one more question, on your switchgear business, what led to the margin contraction on a sequential basis, on a segmental margin basis? Is anything related to material cost, or is it just quarterly deviation, volatility that is
related to product mix?
Okay. Got it, sir. Thank you so much, and best of luck.
Thank you. The next question is from the line of Manoj Gori from Equirus Securities. Please go ahead.
Thanks for the opportunity, sir. So I have only one question here. So we are talking about taking some price hikes in Lloyd portfolio during 3Q. What gives you this confidence that the price hikes would be absorbed, given that during March to May period where the demand was very strong and even the RM prices were witnessing inflationary trend, and at that point of time the price hike...
Just to cut you in, the price increases will happen in the fourth quarter.
Okay.
When the new industry norms will come in.
Yeah. Okay. So I just wanted to understand, like in the period where the demand was very strong, the price hikes taken by the industry and by you were very limited, and given that now overall the consumer sentiments are relatively sluggish and demand is weak and the RM prices have also fallen. So what gives you confidence that the channel would be ready to take that incremental price hikes and it should be absorbed in the market?
I think that the confidence is because of the continued change in the brand and the positioning of the brand in the channel also. So we do believe we will be able to extract the cost increase at least from the market and the consumer.
So in this case, one can assume that the industry itself, at the industry level also, there would be price hikes that one can expect?
We can expect that, but as you have mentioned only that, we really can't be seeing what the industry will be doing, but we do believe that whatever cost increase is happening, we'll be able to pass on to the market.
Okay, sir. That was very helpful, sir, and wish you a very happy Diwali.
Thank you.
Thank you. The next question is from the line of Rahul Gajre from Haitong Securities. Please go ahead.
Yeah, hi. Good morning, everybody. Sir, I have a couple of questions. First, when I look at the overall EBIT margin for the past maybe 2 or 3 years, they have been trending downwards. Now, if I were to exclude Lloyd, even then, the trend has been pretty much similar. So there appears to be more broader weakness in profitability across verticals. So in this scenario, besides the price hike, given the BE norm change, what are the other factors that you are having or looking for, in order to aid improvement in overall margin? And we are not talking about Lloyd right now, the other business. That's the first question.
Okay, so I think we don't see it like that because we definitely believe that there are product mix. There are certain products which are growing at a faster pace as compared to, maybe the very high margin products. Within the businesses also, there has been, enough focus on getting into newer channels and newer kind of customers, maybe project customers, maybe rural markets where there are high investments in sales. So we are not deeply concerned by the fact that there is any sort of competitive intensity or positioning change which is happening in the market. So, but we are trying to cater to a larger set of customers which would require initial investments going forward. And this will continue in the coming years as well.
Okay. So my second question is, given that we've seen slowdown in the channel, have you resorted to lower utilization at your factories, to manage the inventory better?
No, in fact, most of the inventory buildup is happening because of the season, and I don't see that we are not actually envisioning that the next couple of quarters will be a slowdown, and hence we are keeping good inventories for the coming season.
I meant more in the first half. So given that there was slowdown that we've seen, did you resort to lower utilization at your factories?
No. Not really, because the slowdown happened because of the seasonality, and we were building up, whether it's fans or ACs, but we were building up for the season. For example, even for water heaters or appliances.
Okay. So my last question is again on the capex. I'm actually a little confused, because you did indicate that you're looking at about 1,000 to 1,200 crores of, capex over the next between FY23 and 24, of which you already spent closer to 700 crore rupees in the first half. But when I look at your balance sheet,
no, 700 crores for the entire year.
Okay, so how much you would have spent on your in the first half? Because I don't see much movement on your balance sheet on the capex side.
165 crores in the first half.
Okay. Fair enough. I think that's very helpful. Okay, thank you very much and happy Diwali.
Thank you. Happy Diwali.
Thank you. The next question is from the line of Achal from JM Financial. Please go ahead.
Yeah, thank you for taking my question, sir. My question pertains to cables and wires. You mentioned that, as a broader comment, 80% is the volume growth as a percentage of revenue growth. What I wanted to check, if we look at the revenue growth of 18%, average copper price is down about 10%. We're talking about 25% or in 20s kind of a volume growth. Is that understanding right? And is it possible to give some more color in terms of if the mix is changing in favor of cables given the B2B strength you are talking about?
Sorry, actually, there was some break here. I couldn't really follow your entire question. Could you please repeat it?
Sir, my question pertains to cable and wires business. It did indicate the overall volume growth for the company about 10%. Specifically on cables and wires business, given the fall in the copper price on a YY basis, is it fair to say that the volume growth is more than 20% YY? Is that a fair assessment? And if yes, also if there is any change in the mix in favor of cables?
Yeah, so you're absolutely right. So there was a little bit of dip in the prices here, but if you compare it over the second quarter of last year, not a whole lot of difference. But if cables and wires grew by about 18%, so we are actually seeing around volume growth of around 18% in cables and wires.
And in terms of the mix, is it in favor of more cables, which is also impacting the margin, which has impacted the margins for second quarter?
Yes. So actually, wires in this quarter, because of prices coming down, had a little bit of a slowdown. So just a wee bit increase in the cable, but not a whole level.
Understood. And so one more question, sorry, a bit technical. If we see in the June quarter, there was a drop in the copper price and hence the margins got impacted. That inventory got written down already on 30th of June. What explains the further margin contraction on a QOQ basis?
No. Inventory does not get written down on 30th June. Because if you know the inventory, how the inventory is valued, is basically cost of sales price which is lower. So the cost continues to be lower, but obviously it has come down from what it was earlier, but you are still holding because you already manufactured. So when you sell, then only you book the differential. That's what explains, and that's why we are also clarifying that since that stock is almost finished, you see, in wires and cables. So now we expect the margins to improve because now the new inventory which you are getting is at a lower cost.
Got it. So basically the margin impact is only when it is actually sold or realized, and not really about inventory write down as of 30th of June or September.
No. That's why if you remember in Q1 commentary also we had mentioned that there will be a ramification in Q2 as well.
Yes, and the same again played out in 3Q when the copper prices further dropped. Is that understood?
Yes. What will happen next? I hope there is some stability in the world so that nobody can argue right now. But technically, if you are asking me, yes, I think that's how it works.
Got it. Sir, one more question I had. Is it possible to quantify? I'm not talking about the Lloyd business, but ex of Lloyd, what is the reduction in the cost basket? Is it in teens? Is it early teens, mid-teens?
That we can't comment upon.
Okay. Because, the question is coming from the fact that, we are seeing in some of the appliances, there is already a price cut initiated or rather in the form of incentive schemes, etc. in the appliances. So I just thought of checking if, that will drive the price reduction even for the categories we are eating in and for us.
So I think let's wait for Q3 for these questions.
Understood. Thank you so much for taking.
Thank you. The next question is on the line of Naveen Trivedi from HDFC Securities. Please go ahead.
Yeah, good morning, everyone. So my first question is, how are you seeing the overall B2B side pick up, considering last 2 years we have seen this part of the business was under pressure. So in the context of improving the capex cycle and the overall recovery in the B2B side, any comment on the B2B side recovery and how do we look at the coming quarters?
Yeah, I think generally we are positive about B2B. It's still a small portion about for Havells, almost about 25%, but we're seeing recovery. Cables has been doing okay. Professional luminaires is growing. The other businesses like industrial switchgear is also at a decent growth level. So it's showing positive signs.
So are we at in a B2B sort of a revenue? Are we at ahead of the pre-COVID level now?
Yes, definitely we are ahead of pre-COVID levels.
Okay. Secondly, you mentioned about washing machine side, you have seen a good traction. Are we in a position to share some volume number or market share number?
No.
Sure. Yeah. Thank you so much and all the best.
Thank you. The next question is from the line of Amit from Nuvama. Please go ahead.
Thank you. Anuji, hi. Congratulations, first of all, on excellent growth set for first half on a 3-year basis across categories. And I hope everybody, especially at Nirvana, has to be safe and healthy. But I just have one question on the capital allocation. Generally speaking, in cable and wire and electrical segments, we seem to have broadly, have a presence across the basket. But in the Lloyd portfolio, we will have to gradually expand, our presence as we ramp up our SKUs across, whether it's washing machine or other ranges in the white goods basket. So is my assessment correct that in the next 2 to 3 years, more than 50-60%, of the capital allocation will have to be towards Lloyd's portfolio? Or if you can give some color on the capital allocation, sir, across segments.
Well, there is no doubt that if not 50-60%, there will be a higher level of capital allocation towards manufacturing on the Lloyd portfolio. Pretty much, we've completely allocated the air conditioner capacity increase. Washing machine plant is already on board. The only thing, once the build-up happens for the next category, which is refrigerators, that we can consider, getting into the manufacturing in the next 1 to 2 years. So that's something which we can consider. But we have actually, taken the bulk of the heavyweight lifting has already been done. But it will continue in the coming times as well.
Thank you, sir, and my best wishes to the entire team.
Thank you. The next question is from the line of Swati Jhunjhunwala from VT Capital. Please go ahead.
Yes, thank you for taking my question. My first question is, your working capital days are currently at 42 days, and that is mainly because of the inventory. So, what do you think will be the working capital for the second half of this year?
We expect them to come down with the, especially March is one of the lowest for inventory or working capital days. So third quarter and fourth quarter it should start coming down.
Okay. And secondly, what is the rural contribution to the total revenue?
It's only about 5 to 6% of the consumer revenue.
Okay, so do you plan to ramp it up, the rural side, or are you more focused on the urban area?
No. So as I said, different channels are being focused upon, and good investments are being made there. So in the rural side, that focus will continue. We are reaching quite a decent level of penetration there, but more and more products will now start going through the channel.
All right. Thank you.
Thank you.
Thank you. The next question is from the line of Ashish Jain from Macquarie. Please go ahead.
Hi, sir. Sir, I just had a follow-up. Earlier in the call, you spoke about a lot of more focus on rural and institutional side of the business. So is this like necessarily coming at a lower margin for us, or do you think margins are comparable versus our urban or consumer side of the business?
So rural is not coming at a lower margin. Rural is, it's not necessary that these are lower priced products. But in the industrial side, quite a sizable part of that is underground cables, which is definitely at a lower margin anyway. So it is definitely contributing lower margins overall as well. But the other businesses like switchgear and professional luminaires are high margin businesses.
Sir, for this quarter, can you break down like the 14% growth into how much was the growth for industrial or institutional business and how much was consumer facing, if possible?
We're about 25% on the industrial side, and 17%. About 12% on the consumer side, and 17.5% on industry.
Okay. Got it, sir. That's helpful. Thank you.
Thank you. The next question is from the line of Rahul Agrawal from InCred Capital. Please go ahead.
Yeah, hi sir. Thank you for the follow-up. So 2 questions. First was to Anilji. Sir, just utilization of cash. If the company is looking at M&A, what could be areas of interest? Like, is there any product gap which you want to fill, or would you look at new categories? And if new categories, what could those be?
So I think our focus would largely be, as we have also articulated in the past, will be homes and consumers. So it could be something on the regional side. It could be something on the electrical side which goes into the homes. So I think that will continue to be sort of, if we have to scout for M&A, I think we will look at that. Having said that, we also believe there is a significant opportunity in our existing product categories as well. So while M&A, just to use this often repeated phrase, will be opportunistic. But frankly, we don't need M&As to really look for the growth in this current environment. We believe the medium-term outlook is fairly positive for the country. And I think we want to focus on leveraging whatever seeding we have done in the past few years. And we're already seeing that they are bearing fruits. I don't want to get into a few quarters here and there, but medium-term things look very, very confident and positive.
Sure, sir. Sir, actually, I was coming from a capital allocation perspective. I saw that cheaper debt getting repaid, and my sense is internal accrual should be enough for funding capex over in this year, next year. Hence, my thought was we obviously have a lot of extra cash, and hence I was thinking maybe we could, utilize it to fill up something if there is a gap at all in the existing basket. That was what my intention was.
Cash allocation cannot be the reason for M&A. I think and they are 2 independent concepts. So we will see as the time comes. We don't think we have a unsustainable cash levels as of now. Usually we continue to pay 40% payout in terms of the dividend. So I think these things right now, I think we will not sort of concern us. If the time comes, I think we'll take a judicious decision at that point of time.
Got it, sir. And secondly, for the new AC capacity, my sense is it's almost adding 1 million units next year. Obviously, the market size is not growing to that much. Any thoughts on exports here? I mean, is that something which is really looked up to, or is that an opportunity at all on AC?
Definitely. I think exports in general, and I think you are fully aware that how China Plus One is playing out. Obviously, in developed market, it takes time to establish the product. Their approval process is far longer than other countries. But yes, I think not only ACs, all other product categories we are looking to substantively grow and export, and our efforts are dedicated towards that. Coming to this question on ACs, yes, I think export will be big focus, both from the existing, but actually this could be a more conducive from the new factory, which is near the port as well.
So we could see like 2-3 lakh units going out of country from the new unit. Is that possible, like next year itself?
You're just putting another timeline to that, but I think yes, substantive numbers are possible. Why just 2-3 lakhs?
Okay, sir. Thank you so much. Thank you. Have a good Diwali. Thank you.
Thank you.
Thank you. The next question is from the line of Pranjal Garg from ICICI Securities. Please go ahead.
Yeah. Hi, good morning, sir. Thanks for the opportunity. Sir, one of the competitor tied up with Mahindra Logistics for third-party logistics services some time back. As the freight costs might be likely impacted due to fuel costs, and Havells will also be penetrating deeper in the rural markets, will we also likely go forward for any such partnership for using third-party logistics to improve the efficiency?
No, look, these efficiency measures could be third-party logistics, could be independent parties. These are the optionalities we keep reviewing as a business process. So whether we tie up on a national basis or regional basis, these experiments keep happening. So I don't know that whether Mahindra would be one or who could be, but yes, these are the things which continue to evaluate. These are operational issues.
Okay, so there is nothing of that sort in our books right now. We can assume that.
I think these are in our books. Sorry? What is on our books?
So something that is not in our consideration right now for going for a third-party logistics.
I think these are 100 things are there in the operational configuration. You see, that's something we are not discussing on the call. What is our operational strategy?
Okay. Sure, sir.
Very good.
Thank you. We take the last question from the line of Sujit Jain from ASK. Please go ahead.
Yeah, sir, just to clarify, because in the call, I think you've spoken twice about this. The price hike in ACs will happen from fourth quarter, you said. You can ask for the second time.
That's right.
Right. And cable wire mix moved towards cables in this quarter.
A little bit, yes, because, in wires, because there was again fluctuation, prices were coming down, so there was some destocking happening in the wire segment in the second quarter. In fact, if you see the third quarter of last year, there was high amount of stocking because there was, prices were going up. So actually in this quarter, we are operating on a very high base of wires. So actually again, especially in case of cables and wires, one should not be really excited or, deflated by the quarterly trends.
Right, and the volume growth will be higher than the sales growth YY for C&W, which was at 19% because of the price falling in copper.
Slightly, because you're comparing over the last year, not just the sequential. So YOY, they will be almost the same.
Okay, and one last thing about Lloyd's margins. You said it will improve in Q4. Contribution margin double digit, which means when I look at quarters when it achieves that.
Because this is a trend which we are seeing. It is upward, right? So going forward in the third quarter, we definitely see a major improvement coming in. Fourth quarter, we are expecting normalized margins to start coming in, which we had been operating at in the past. But as was discussed, there will be a lot of changes in the AC industry in the fourth quarter. So we will play it at that point of time. Definitely, we would like to pass on the entire cost increase in the fourth quarter.
Yeah, I understand that, but then that translates into 4-5% kind of EBIT margin.
But that's something which you will have to translate into, yeah. As I've said, we'll continue to invest in Lloyd for the next 1 or 2 years for gaining market share as well as creating a position in the market.
Okay, sure. Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference back to Mr. Aniruddha Joshi for closing comments. Thank you, and over to you, sir.
Yeah, thanks, Aman. On behalf of ICICI Securities, we thank the management of Havells as well as all the participants for being on the call, and wish you all a very happy Diwali. Now I hand over the call to the management for the closing comments. Thanks, and over to you, sir.
Thank you very much. To all a very, very happy Diwali from Havells. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference. Thank you all for joining us, and you may now disconnect.